Good morning, traders. This is Brad Matheny. Today is February 11th. Today we're going to go over the TTScanner Hotlists. And before we get into the data and the charts, I want to remind you to please come to visit MENT.com Technologies. This is my website. This is where I deliver all of my research and my videos. I like to say I do the research, you make all the decisions. What I'm trying to do, ladies and gentlemen, is help you better understand what's taking place in the global markets and prepare you for the trends that are setting up, knowing how to more efficiently and more effectively deploy your capital for growth, to protect against downside risk, and to provide you some real advantages going forward. For example, nobody wants to hold on to assets when the markets are turning sideways. Nobody wants to experience a 20 or 30% drawdown only to have to wait 6 or 7 years to pull it back, see it come back. And that's where my research really comes in. I have tools, technology, modeling systems that are designed to help investors and traders and everyone who has money in a 401k or a trading account, any type of assets. I am trying to help you manage and grow your assets. Come to the website, check it out, join the Expert Growth membership to support my research, and then explore some of the fully automated trading strategies that I have available. Membership is one membership, includes everything. So you get everything under one simple membership, and prices start out at about $55 a month for monthly, all the way down to about $42 a month for annual. Again, you get everything. And if I'm helping you manage or grow your assets by doing this research, that's the ultimate goal. What you guys can do to support me is try to become a member and support my research as we go forward. Pay attention also to the incredible SPY cycle patterns. These things have been nailing the markets, and I think you'll really be impressed with what's going on with these. If you're an intraday trader or a swing trader or an options trader, these can really help you understand what's going to come and how the markets are going to react. Okay, let's get over to the charts real quick. This is an S&P or SPY weekly chart. And what we're looking at is we now have a confirmed move above 410. Right down over here was a move above 410, which confirmed an upward price trend. We had been setting up a bottom down here, which I assumed was a wave 4 end, starting a wave 5 bottom. We do have a higher high, higher low, followed by a new higher high. Now we're in a slight pullback. I believe this pullback is going to stall out fairly quickly. We may see some weakness through the next week or two in February, some sideways trading, but I believe what we're looking at here, ladies and gentlemen, is an A move up. Try to draw this correct. A B move down, a C move, which should be higher than or bigger than the A move. That puts us up into this area, possibly over into here. Then we're going to see a period of correction here near May, June, July, I believe, setting up a bottom, followed by a move to the upside, which may extend up a little bit before we go ahead and see a moderate correction back down here, which would be the end of this first wave. So this would be wave 1 of a bottom. Think of it as wave 1 to the upside, setting up a bottom. Okay? We're looking at a real solid move here to the upside. What may be a bit of an extension. Remember, this April through July period could be a bit of a consolidation, and this would be the end of essentially wave 1. We have an A, B, C move here into wave 1, followed by a wave 2 down here, followed by a wave 3 up here. So this would basically be an A move, a B move, and then a C move. And theoretically, that would be wave 1 of the new wave 5. Ultimately, the opportunity for you right now would be a bit of a move here. Remember, we have a potential here for, and let me see if I can get the mouse to cooperate. We have a potential for a 6.5% move to the upside, and or see if I can grab this and move this. and or at this point, we have a potential for a 9.4% move up to a potential 12.29% move. So understand that there is a real potential here for a solid 6.5% move to the upside on the SPY. That is relatively substantial when you consider what's taking place. But then we have another opportunity back here, probably in somewhere around June 8th, 9th, 10th, maybe all the way out to July 4th, before we enter into another big phase, which would be a potential 12% move to the upside. Now, why am I drawing these lines the way I'm drawing them? Let's take a little bit of time to educate you. So we have a scenario here where I've drawn these horizontal dash lines. You can see them here. They're not quite horizontal, they're upward sloping. It's very important to understand that as long as we stay in this channel, we're likely to continue to drift upward or bias to the upside. I do believe this April, end of April, early May period is going to be an extended period of weakness. You're going to hear a lot of people telling you that the markets are rolling over and crashing. We do need to be aware that this potential drawdown could come back down into these areas, potentially even down into these areas. Remember, this is our A, B, C move to the upside. So we could come back down into these areas, even back down to these lows, theoretically, under Fibonacci price theory. But I believe we're going to find support above this 410, call it 404 to 410 area. And we're going to find support here, and we're going to rally back out of it. What's taking place right now, ladies and gentlemen, is unless we have some kind of a catalyst for a crisis, global war or global financial crisis, we're moving into this migration of kind of a sideways upward trend, very similar to 2002, 3, and 4. So we do have a very strong opportunity for this to play out exactly as I've drawn it, moving just like this, up into the 435, 436 area, back down to the 414, 415 area, back up into the 458, maybe 465 area, and then rolling over possibly into early 2024 before we get another big move to the upside. So we'll see how this plays out. This is, again, almost 12 months out into the future. We'll update this as we go. But the reality is we're in this sideways channel. You can see I've kind of drawn this as a sloping channel. And let me try to do this because this is really where we're at here. We'll duplicate this. We'll move this. And we'll put this down here. And we'll slope this back up to the upside. And where we're at, ladies and gentlemen, is we're kind of in this channel right now. Eventually, because this is an impulse move, we will see this weaken. We will see this come down and maybe angle more like this. But again, this is our basing bottoming formation. This is our trending formation. And as long as we stay above this yellow line, in fact, let me carry this all the way out. Try to guess at where I think price will stay confirmed, about there. This is about the area that we're going to see wave 1 move. So hypothetically, this is wave 1 of wave 5. We have an ABC move. I believe this is going to be the end of it, possibly moving into an ABC corrective D, followed to an E. E could be bigger than C. It's happened before. That's part of the the Elliott wave price structure. And I believe that once we get a breakdown in this area, or potentially in this area, we will have determined that this initial impulse wave 1 will have ended. This would be basically wave 1 of 5, wave 2 of 5, and then wave 3 of 5 potentially to the upside. And again, wave 5 could be either an ABC pattern or an ABCDE 5-wave pattern. But in theory, ladies and gentlemen, we are bullish. We are expecting the market to consolidate throughout most of 2023 and move into a solid upward trending back over here in July, August, September, which is where real opportunity is going to set up for you in the markets. We are already bullish in the MENT Rotational Modeling system, but because we're in this flagging formation right now, this sideways consolidated trend, there's a lot of, let's call it mixed bias right now. My analysis says we're in bullish trending. A lot of people think that the market's going to collapse and roll over and move downward, which it still could do. We'll just have to play it week by week and see how it plays out. Okay, now let's go over to the TTScanner hot list. This is the core hot list, the TTScanner core hot list. You can see right up here, core list 2022. This was created last year. We have no new triggers. So you can see we're, again, mixed bullish triggers and bearish triggers with a number of warnings. We have positive thrusting for the most part across just about everything, which is good. That indicates that these markets are moving, thrusting potentially to the upside. And remember, this is the core list, so this is not the inverse list. If the markets are going to turn into a bullish trend, we're going to see this move to primarily bullish, and we're going to see positive thrusting patterns. We have many old triggers here, 52 weeks old, 56 weeks old, 39 weeks old. We have nothing new. These triggers have held up very well. We have a short signal in the marijuana sector from 39 weeks ago, 45% profit. We have a long trigger in XLE and a long trigger in XOP, 56 to 52 weeks ago, 46% profit and 27% profit. Nothing new. These have already hit our targets. You can see these are purple. That means our targets have been hit. Our stop levels are right here. Our entry price is right here. We basically need to continue to watch these. Now, these are trades that, you could hypothetically, because they're long, look for new entries on the daily chart. But I would warn you that these trades have already reached their targets and matured. So we need to be cautious. These are essentially exhausted trades that are still continuing. I would not chase these with a lot of money. Next, we have the core inverse list. Now, we had a number of triggers last week, new triggers. And you can see here that ERY went flat after a new trigger, and it looks like JDST went flat after a new trigger. We have a couple of new triggers this week. You can see here we have FAZ as a new short trigger. We have HDGE, which is Trust Equity Bear ETF. New trigger, it's off 5.25% as of Friday. We have a couple of triggers that survived last week. A new short here in HIBS, which is 1 week old, is up 8.87%. We have a new trigger here in EPV, short Europe, which is off 1.4%. We have a new trigger here, which is long SVXY, the short VIX, which is off 2.95%. And we have a new trigger 1 week old here, SOXS, which is short. It's up 14.20%. Haven't hit any targets yet. Obviously, this negative price structure is calculated based on range. There's no way we're going to get down to a negative target level. So you would focus on the primary target level. Same thing here. There's no way we're going to get down to a negative level. So you would focus on the primary target level, which seems quite low, actually. And again, these inverse ETFs can present these types of numbers, especially in extended trending. So we have a couple of new triggers that are playing out okay. A couple of triggers that are 1 week old, which is great. One trigger that is 4 weeks old in Yang, which is a short trigger. It's off 11%. Now remember, when you're looking at these, you're going to be trading your trading capital broken into 10 or 15 or 20 trading slots. So in theory, this is really, if it's broken into 10 trading slots, this is a 1.16% loss. This is a 0.14% loss. This is a 0.295% loss. This is a 1.4% gain. This is a 0.062% gain. This is a 0.55% loss. Remember, you're not putting all of your capital into every single one of these. What you would want to do is take a look at these to determine which ones are suitable for you. Now remember, the inverse list is designed to be taken advantage of in a downward trending market. So these are designed to be really more of a focus for you in a downward trending market, which we do not have a huge downtrend right now. My rotational modeling system and my analysis is indicating an uptrend is taking place in the general markets. So you would want to cut your allocation in this short inverse list, this core inverse list, to a very small amount, maybe half or a quarter of your true allocation, which would allow you to still take these trades if you wanted, but limit your risk exposure, seen as though we're in a new uptrend. Okay, let's move to the basic. I'm going to shrink this a little bit. See if I can get this into the right size. This is the core ETF list. So these are the main ETFs. And you can see here we have no new triggers. We have the XOP and XLE that are still the primary triggers, but look at how bullish everything is getting. We're starting to get a lot of bullish signals here. We're starting to get some decent positive numbers over here in the thrusting system. These will turn green as the trend continues to bias back to the upside. These will turn green, and we will start to see an upward trend take place with new bullish triggers in these signals. But right now, we're getting very few triggers, which means the markets are consolidating, flagging out, waiting for the new trend. Now, as I mentioned to you, remember, let's come back to this chart. In this mode, as we start to move up, if my analysis is correct, we'll start to get some bullish triggers. But I want you to focus on target 1 with these bullish triggers, because we're going to be anticipating this April, May, June market rollover. So we're not going to have the potential to see real extended trending here. Focus on target 1 with the TTScanner Hotlist. That's going to be your primary objective. Secondarily, once we get back over here into June, July, we get into this next phase. This is where we have some real chance of seeing 20, 30, 50 weeks of upward trending before we get this rollover, maybe in February, March, April of 2024, okay? So the real opportunity comes from waiting and playing your capital efficiently, which is why I'm recommending that you, again, we're looking for a bullish bias. You want to be cautious. You should only be trading a small amount of your capital into your trading account right now and have a proper cash reserve. Follow the MENT Rotational Modeling and Real Estate video to understand how you should be allocating your capital right now. The TTScanner Hotlists are basically providing us with abilities to find weekly swing trade setups. They must align with our analysis. They must align with what we're expecting. Otherwise, if you take them and they're counter to our primary trend analysis, you should be allocating very small capital amounts to your trading that trade against the primary MENT Rotational Modeling System basis. And lastly, we have the value list. Now, the value list has been quite consolidated. We've been getting triggers theoretically up and down. We've got a couple that have lasted now. Smucker's has now lasted 11 weeks, is up 3.65%. Caterpillar has now lasted 7 weeks. We're up 5.89%. We've hit our first target with Smucker's. We hit 2 targets. The one here is Travelers Company is up 2.56%. We have not hit any targets yet. This could still be a very valid trigger, ladies and gentlemen. We're trading at 189. Our stop's at 178. We have a target at 196, it looks like, 25 and 210. This could be a very solid trigger still. And we have a trigger last week on PFG. PFG has been on and off with triggers the last couple of weeks. This happens. What happens is we're trading sideways. We're not getting a whole lot of momentum to the upside yet, particularly in these value lists. So we could get these on and off types of triggers. But now we have a trigger that's 1 week old. We're at 91. Stop level is a 91.19. We're likely to get stopped out of this because our last is 90.41. This will more than likely trigger again, and we have a new trigger here on OMC, Omicron Group, 91.54. Stop is at 90.16, currently trading at 91.14. We're off 0.44. I believe these are continuing to flag out. What we're seeing is these patterns are, these stocks are basing, they're building kind of a momentum base, and the next phase is going to be a whole bunch of triggers that stick and get us to the upside with regard to these. Now, these stop levels, like I said, when they go on and off, this is because they're showing bullish momentum, but they're still not really following through. So our stop levels are getting tagged. If you're going to play these, my advice is to go in with smaller anchor positions. Remember, the markets need to really consolidate and move out of this basing pattern. So again, back here, we're in this sideways flagging formation. You can see it here, kind of a broad flag. We could roll a little bit sideways for the next couple of weeks, indicating that we're just struggling to get out of this mode. Eventually, I believe we're going to move back up into this 425, 435 area, and that could present a very solid rally phase, 6, 7, 8% possibly, depending on where we bottom over here. And this is going to generate a new momentum upside bias. And that's why we need to be very cautious. Now, I will show you, let me come here and back here. Drag this over, and this is the allocation level. So this is where you should be with your allocation, ladies and gentlemen. You basically should be 50% trading in stocks, 25% cash, 25% metals, and 0% bonds. This is based on my MENT Rotational Modeling system. Alternately, you should be 65% stocks, 35% cash, and 0% bonds. That means that you should be trading essentially 50% of your capital into these stock trades if you wanted to, broken into 10 or 15 or 20 trading slots. Now remember, I'm recommending that because the MENT Rotational Modeling system is bullish, as you can see here, up here, for the SPY, we're expecting a bullish trend. So you would essentially be trading stocks that are more efficiently aligned with the overall general market trend. And when we get into these hot lists, you would take a look at these hot lists. Again, take a look at a trigger like Smucker's, or let's take a look at this one here, PFG. So Principal Financial Group is this one with the number 1. And what I want you to focus on is these triggers over here. We have a profit factor of 1.02, which is pretty good, and a win rate of 2.14, which is, again, pretty good. Now, the way I rank these, and I've gone over these with you a couple of times, is the lower the profit factor and the lower the win rate, you want to allocate your money a bit more efficiently. So theoretically, a lower profit factor with a 1.0 win rate means that it's got a decent profit factor, not huge, and it's got a win rate that's pretty much 1-to-1, okay? So at that point, you would be looking at this saying, okay, because this is lower and because this is 1-to-1, maybe allocating 30, 40, 50% to this trade. You can see where we're at here. This trade, which is Caterpillar, has got a profit factor of 0.85 and a win rate of 1.70. Because this profit factor is higher, closer to 1, and this is above 1.5, you may be allocating capital in the 50, 60, 70% of your trading slot. That means that, you know, again, you could allocate a bit more capital to this trade because the win rate shows and the profit factor shows it's a bit more consistent. This one has a fairly strong consistency. I mean, this is good. This is really good. You could allocate 100% of your capital to this trade. This one here with the new trade trigger at a 20%, 0.20 profit factor and a 0.40 win rate, I would only be allocating 20, 25% of my capital to this trade if I wanted to take it. Use the thrusting scenario as a measure of intermediate trend. This is all based on weekly. So this is telling us right now that these are green here with negative numbers, telling us that we're in a bullish trend, but we're in a pullback scenario with regards to thrust. This is in blue, negative number. This is telling us that we're seeing a more moderate pullback. And this is short red with a positive number. This means we're in a bearish trend, but we're seeing a bullish pullback in the bearish trend. This blue 30.24 indicates that we're got a new trigger in moderate upward trending with a 30.24 thrust. We would expect to see this continue to move higher. But remember, the win rate and the profit factor give you a guide. So here's a decent trigger, 1.0861. Here's a decent trigger, 1.45 and 56. This is a not so decent trigger in the sense that, and I guess what you could do is take this number and multiply it by this number to determine essentially how you're going to allocate your capital. So, you know, a 1.02 times a 2.4 means you could essentially allocate 200% of your capital this trade. I wouldn't recommend that for your trading slots. But again, anything above a 1 when you do the multiplier means that you could become more aggressive. This has got a fairly high success rate. In a scenario like this, 0.2 times 0.4 is going to put you at a scenario where you're at 0.18 theoretically. So this means, you know, 20, 25, 30% of your capital. 0.85 times 1.07, this is going to end up 1.70, going to end up being about 1.4. That's above 1.0. So this would give you the idea that you could be in the 80, 90, 100% allocation. 0.49 times 1.0 is going to be 0.49. That tells us that you could be in the 40, 50, 60% area. 0.61 times 1.08 is going to put us about 0.68 or so. And that means that you could be in the 50, 60, 70% allocation area. And this is a good way for you to determine how you want to take the trades. But remember, you want to stick with your trading that is in alignment to the bullish bias or bearish bias of the MENT Rotational Modeling System. If the MENT Rotational Modeling System is mixed, you want to be very cautious. Cut your trading in half, maybe by 2/3. If the system is MENT Rotational Modeling System is bullish, then you want to start looking for bullish triggers on the TTScanner Hotlist, and you want to allocate your funding accordingly. Remember, this gives you a guide as far as how you want to be allocated. You should be reserving at least 25 to 40% cash right now and staying properly hedged. You should not be aggressively allocating your capital into trading. We are waiting for the SPY to actually move into confirmed trending, which will probably happen sometime around, you know, March, April, somewhere around that time frame. We'll get a nice little rally here for 5, 6, 7 weeks, and then come end of April, early May, we could see us move into this sideways topping pattern and pull back maybe 7 to 10%. And that's what I expect to happen. Okay, guys, I'm going to move on to the next video. I'll do the MENT Rotational Modeling and Real Estate video next. But again, follow my research. Go to MENT.com, learn how I can help you. And I want you to be aware that you still need to be cautious. Right now, we do not have any reason to become aggressively long at this point. Yes, we may see a 5, 6, 7% rally over the next 4, 5, 6 weeks, maybe a bit longer, but it is nothing to get overly aggressive with. We could also see markets pull back if some sudden crisis event takes place. And who knows? I mean, the world is a crazy place right now. If nothing happens, we should resolve to the upside. If there's some crisis event taking place, we could see a broader downside risk take place very suddenly. All right, guys, visit MENT.com, join Expert Growth, and let me know what I can do to help you improve.